Hello everyone, and welcome to the latest update of our Global Outlook. My name is John Ferguson, Director of Global Forecasting and Country Analysis here at the EIU, and today I'm joined by Caelan Birch, our Global Economist, and Nicholas Fitzroy, our Risk Briefing Director. We would like to cover three areas today to update you on our latest analysis. We'd like to talk about Iran and the Iran nuclear deal, the oil market and the US economy. Nico, maybe we can start with you. Mr. Trump pulled out of the nuclear deal in May. At the time, we flagged to our clients and talked about it here in terms of the impacts we would foresee both for the Iranian economy and the region. But now we're a few months down the road. Maybe we can start with the impact of sanctions. Can you give us a bit of a picture about how these are playing out on Iran's sort of domestic, political and economic scene?
Well, so it's already had a pretty profound impact on the Iranian economy. The Iranian rial has collapsed, the unofficial rate has collapsed. Inflation's hit its highest level since early 2014. Economic growth has slowed, and a number of companies have withdrawn from Iran already. So when oil sanctions come in November and its oil exports are curtailed, we're looking at a pretty grim scene for the Iranian economy. We'd expect it to go into recession next year, pretty steep recession at that. And all of this is heaping on pressure on the president, Hassan Rouhani. I think he'll survive his term simply because they don't want a destabilising presidential election at this time.
Right.
But certainly he's under a lot of pressure and he's ceding a lot of ground to his hardline opponents within the regime at the moment. And while this is going on outside the sort of political sphere, there's serious social unrest that's been ongoing throughout the year, mainly through economic grievances. And so if we think that inflation is also soaring now, the economy is about to go into recession, those issues will be exacerbated, and we're looking at potentially regime-threatening protests in the next few years.
Absolutely, and so that's a lot of pressure on the domestic scene there, Iran. But you mentioned there are companies pulling out. So we've seen moves from the EU in terms of putting a statute in place to try and protect European companies doing business in Iran. But in our view, that's really not going to stop European companies making that hard decision to pull out of Iran, which adds to the pressure that you just spoke about.
I mean, ultimately, the US is a much bigger market than Iran.
And that's the choice for some of these companies.
Exactly. Effectively, that's the choice. So particularly for European companies, which tend to be pretty interconnected with the US economy, for them, the choice is it's a simple one. They have to cut loose their Iranian ties.
Absolutely. So there's a bit of a difference between what the EU is trying to do politically and what then the sort of situation for companies on the ground there in Iran. That makes me think of the question, the domestic pressure that's going to be piled on the citizens there in Iran, who will they blame? Will they blame Mr. Trump? Or will they blame the Europeans? How will this play out in terms of who they blame? You mentioned sort of threatening the regime. Will most of the blame go towards the regime?
Well, certainly the regime will try and pin this on Trump and the US. That's typically what it's done in the past, and now it's got a pretty good reason to do that with the US withdrawing from the deal. But I think there's real antipathy and frustration towards the regime at the moment from many parts of the population in Iran, and I think that will increase over time. There's a sense that after a couple of years without sanctions, that the authorities missed their chance to kind of reignite the economy.
Right. Okay. So that's the domestic scene. What implications does this have for sort of regional security? How's this playing out in the wider region there in the Middle East?
I mean, one argument you could make is that as financial resources are tightened, that maybe Iran will look to draw back its financial support for proxies in Lebanon, Syria, Iraq. But I think actually what will happen is, given that the hardliners are gaining an influence and therefore kind of playing a bigger part in foreign policy decisions, I think basically Iran will double down on what it has in Syria and Iraq. And the risk there is that this could lead to international kind of escalations where there are US troops in Syria and Iraq.
Particularly in Syria.
Yeah, particularly in Syria. And I think the biggest worry is that Israel-Iran could be the source of a new kind of international conflict.
Right. And that's the one probably we're most worried about?
I think in terms of a new conflict breakout in the Middle East, that's the biggest concern at the moment. Right. Israel's been striking Iranian positions in Syria. Yeah. If there's a big retaliation at some point, then that could really escalate.
And the fear with them would be that other powers would be drawn in, like the US and their
exactly.
proxy allies.
Yeah, that would almost certainly draw in other powers, yeah.
So risks are certainly elevated. Given what we've just spoken about with the regional sort of implications, what does this do for the prospects of possibly renegotiating the deal between Iran and the US?
Well, firstly, I think the deal will remain in place at the moment. Iran will stick with it.
Because enough of the other signatories want
exactly.
to maintain it.
Exactly. None of the other signatories want to get rid of it at this stage. And even if the economic benefits are not really there, it doesn't do Iran any good to sever ties with Europe. And there's a sense that maybe it will try and wait out the Trump presidency. But in terms of renegotiation, at the moment, I would say that's very, very unlikely. It would be unpopular domestically in Iran. And also, there's no real trust between Iran and the US at the moment, and so it's difficult to see how that would begin.
And I imagine also from the Iranian point of view that they wouldn't want to bring in their regional behaviour or the regional sort of issues into those discussions.
That's the other thing, is the demands being made by the US at the moment are too severe for the Iranian regime, and also if they were to sort of say, okay, we'll give you what you want, again domestically it would be very unpopular. It would be seen as kind of giving in to all of the US's demands.
Absolutely. Okay. Thanks, Nico. Caleb, maybe this is a good time to talk about the oil market. This is one of the many risks, sort of the geopolitical risk impacting the oil market. What are some of the key factors affecting the oil prices at the moment?
Yeah, well, Iran is certainly one half of the equation. And on the other side, we're seeing kind of factors working in opposite directions, and that's the growing US-China trade war. And I think between those two factors, we're going to see oil prices stay in that kind of range-bound environment. The Iranian situation is worrying because already the oil market is preparing to have a loss of Iranian supply. We are not forecasting a dramatic drop in Iranian exports, mainly because we think they'll maintain some kind of partial access to export markets outside of the US and Europe. So China is one, India is another. We've seen a number of currency swap agreements signed, a small number, but a few that will allow some countries to continue to import oil directly and not have to use US dollars to make that transaction, and therefore be able to avoid the impact of sanctions. But that's looking pretty minimal, and even India has already started to cut its imports from Iran in recent weeks and months. So there's a constant fear, even though the sanctions haven't been reimposed formally yet, there's already kind of that factor pushing oil prices up, and we've seen them reach the $80 per barrel mark in September, the first time since May, when they rose also related to fears over Iran. So we'll continue to see that kind of pushing prices up in the following months. But on the other hand, even though we saw prices shoot up to $80 a barrel a couple of days ago, in the last 2 days we've seen them fall right back down to about the high 70s as a result of the new tariffs imposed by the Trump administration on China. The U.S. is now effectively taxing half of what it imports from China, its largest source of imports, and this will start to feed through into the domestic economy. And the main concern is that the higher price of inputs and then the higher price of consumer goods in the U.S. will weigh on manufacturing activity, and if there's less being produced, both in the U.S. and China, there's less oil being consumed, and there are now kind of growing concerns in the market that demand growth just isn't going to be what we had expected it to be in the next couple of years.
Right. Okay, so a number of things to buffet the oil market. You mentioned the range bound between $70 and $80 a barrel. What could possibly break it out of that range, that wider range?
So I think it would be an extreme situation of either of those two factors we just talked about.
On the up or downside.
On the up or the downside, exactly. So because we expected Iran would maintain some access to export markets and therefore be able to kind of retain some export revenue, if the U.S. were to really crack down, or if China and India and some of these other buyers decided it wasn't worth the time and trouble and kind of antagonizing the U.S. to continue importing from Iran, if they stopped buying entirely, we would assume that would provoke kind of a widespread market fears over kind of the instability that the Iranian economic collapse, not just the loss of exports, but the economic collapse involved in that situation, what that would mean for future oil supplies. If that would provoke a conflict between Iran and another country, Israel, for example, that would disrupt supply chains throughout the region and all of that. That would push prices way up. If the U.S.-China trade war were to escalate, ironically, that would push prices much further down, really, because that would have the heaviest impact on the sectors that are the highest consumers of oil. So that's transport, construction, and manufacturing. And there are a lot of concerns that, there really isn't a sign of that kind of trade war abating anytime soon. So the only way it would change would be for it to get worse.
Right. Okay. So you've mentioned the trade war. So let's now come to the US economy itself. We spoke last month and quite a few times over the last 6 months about the trade war, and we at the EIU now believe we're going to see a what we're calling a bilateral trade war between the US and China. So not quite a global trade war that brings in everybody, but definitely a bilateral trade war between the US and China. How is that affecting the US economy?
The US economy at the moment is still in kind of this neat balance, really, where we're seeing very strong economic growth, 4.2% in the second quarter, which was revised up slightly. So the numbers continue to look very strong. And job growth continues to kind of to plow forward, even including in August. So we've gotten through the first half of the year and the numbers are still looking very strong. Inflation is starting to rise slightly compared to the beginning of the year, but it's, by no means kind of runaway inflation. And wage growth is starting to pick up slightly, but also not so fast that we can assume we're at the end of the growth cycle and that we're going to start to see some overheating pressure. So for 2018, at least, the situation is still looking pretty good in terms of real data coming out of the economy. On the other hand, where we're starting to see kind of the beginning of the negative impact of this trade war is on the sentiment side. So it's both business sentiment and consumer sentiment.
Which is a pretty good early indicator.
It is
where this is going to go.
Yeah, absolutely. Because I think we'll start to see kind of a double impact. There are plenty of reasons why you could argue really that the US kind of toughening its stance on China is good for the long-term competitiveness of US firms. There are some very solid arguments to be made that tech transfer requirements in the past kind of couple of decades with Chinese firms has led to the handing over a lot of kind of sensitive technologies that will make US firms struggle in the future. So we're starting to see a kind of a consensus growing kind of between Democrats and Republicans that toughening our stance on China is actually going to be beneficial for the economy. That may be a long-term concern worth keeping in mind, but in the short term, I think we'll see a double impact of tariffs, and tariffs are an interesting way to go about putting this pressure on China. So we'll start to see it both in terms of kind of the slowdown in manufacturing output, because input costs are higher, energy costs are now slightly higher, all of the steel and aluminum tariffs and all these things mean that businesses will pay more for their goods, and that the final product will also be more expensive, including imported final products. So that'll hit consumers' bottom line too, probably in the next 6 months.
Absolutely. And just to remind people, last month we took our 2019 growth forecast for the US economy down to 2.2% from 2.5%. So at least in our view, the economic impact is pretty meaningful over the next 12 to 18 months.
Yeah, absolutely.
So we've got this interesting situation where the economy in some respects is doing really well and has been building in that direction for a long time, but for us there are definite clouds on the horizon. What does this mean for the policy direction of Mr. Trump and the Trump administration?
Right. Well, the Trump administration has kind of prioritized fast economic growth since the very beginning. Even before he was in office, Mr. Trump was talking about 4% annual GDP growth. The tax cuts were predicated on the basis that lower tax burden meant faster growth and higher corporate spending. This has been one of the few kind of ideologically consistent messages coming out of that administration. If we do start to see kind of a wobbling in the economic numbers, especially given that we think Democrats will retake the House of Representatives, the lower house of Congress, in the November midterms, though they'll maintain control of the Senate, this is going to send kind of a double warning signal, I think, to the administration. And there may be a rethink of some of the tariffs down the road, probably not with regard to China, because again, there's this growing consensus that the U.S. and China are competitors, and something's going to have to switch there. But with tariffs on Chinese and Mexican goods and European goods and the continued threat of automotive tariffs, there may be a rethink of that strategy as the administration has to refocus on supporting growth. Absolutely.
And again, in our view, it's hard to see a resolution to the fundamental issues between the US and China. So even if the approach moves away from tariffs, which we think it eventually will, this sort of dispute and disagreement will carry on for a lot longer, which is essentially going to keep weighing on growth. And I imagine we'll keep talking about it for the next 6 to 12 months.
That's for sure.
Kaylin, Nico, thanks so much for talking. And thank you to all for listening. Just a reminder, for those of you who are subscribers to Risk Briefing, our commodities reports, or our country reports, you can go to our website for more details, of course, of this analysis. For those of you who are not, you can still get some free analysis at eiu.com and also follow the various Twitter feeds from our various analysts and regional teams. But thanks again for listening. We'll be back next month with another update of our global outlook.